iShares Core Dividend Growth ETF, or ticker symbol DGRO, has been performing very well this year so far year to date, especially when you compare it to the general market. Now there's multiple different reasons this ETF is holding up quite well with all the current market volatility. And for all those reasons, I wanted to make a video highlighting some of them and sharing with you guys what this ETF has to offer, how it works, and how it's, especially as of right now, being looked at as a safe haven as money starts to flow into it. So in this video, we're going to go over the iShares Core Dividend Growth ETF, share with you guys again what this ETF is, how it works, and then later on share with you guys why this ETF is potentially perfect as a long-term hold, especially during turbulent times. So if you're a dividend growth investor, you're definitely going to want to stick around until the end. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. So first off, the iShares Core Dividend Growth ETF, it says right here why DGRO. Number one, DGRO offers low cost exposure to US stocks focused on dividend growth. Now I've probably made 100 videos at this point talking about why I personally think dividend growth is one of the most important metrics, especially when it comes to building a long-term portfolio. And that's because even if you aren't getting the biggest amount of cash flow from day one, over time buying into different stocks and or ETFs that do have a high dividend growth rate, you're basically going to be getting a raise on your dividends year after year. It says number two, access companies that have a history of sustained dividend growth and that are broadly diversified across industries. Lastly, it says use at the core of your portfolio to seek income. Now, the investment objective says this: the iShares Core Dividend Growth ETF seeks to track the investment results of an index composed of US equities with a history of consistently growing dividends. So in an environment where we might see bonds start to go down in yield and where we're seeing investors run for the hills when it comes to high growth AI stocks, etc., we're seeing a lot more investors turn to the dividend payers, which are sort of tried and true. Now, some of the top holdings in DGRO, not the most flashy, not the most insane stocks by any means, but tried and true businesses, companies that have consistently made profit over the years. Names like Johnson & Johnson, AbbVie, JP Morgan, we have ExxonMobil, we have Apple stock at Microsoft, so we still do have some information technology exposure also. Names like Broadcom, of course, Procter & Gamble, Coca-Cola, a very well-diversified portfolio with over 400 different stocks within it, which again is why this ETF might be perfect for that investor out there that doesn't want to be exposed to some massive volatility. Now, I came across this article on seekingalpha.com from Macro Girl. It says DGRO superior in turbulent times. This writer broke down DGRO very well, especially during the current situation that we're in. It says summary, DGRO's effective screening process and balanced weighting system makes it a strong buy for 2025's volatile market environment, excluding high yield stocks and focusing on quality ensures steady gains, and that it's more attractive than the S&P 500 and other peers. They then said it may lag the SPY, but not by much, and the underperformance may well narrow. Under different conditions, I rate it as a buy. Strong stocks have generally gone nowhere since then, and the S&P 500 SPY is trading back to the October range. It is now down for the year, where DGRO, for example, is green year to date. Now, first off, DGRO stock selection. DGRO is a passively managed fund that tracks the Morningstar US Dividend Growth Index. This uses a simple yet effective screening process with rules on dividend growth, payout ratio, and earnings forecasts. Next, it says by excluding stocks in the top 10% of dividend yields, DGRO effectively cuts out a lot of weak stocks that may have met other rules. Walgreens, for example, comes to mind. Prioritizing quality and strength instead of yield is a plus for total return, even if the quarterly dividend of 2.16% trailing 12 months is hardly impressive. That said, the dividend growth element not only selects quality stocks, but also means distributions steadily grow, which also means if that 2% dividend yield doesn't really excite you, maybe in a few years it will. Now, DGRO has been perceived as a defensive titled fund, but it doesn't necessarily prioritize safe sector or metrics in its methodology. Indeed, its sector mix is 18.65% exposure into names like Apple, Microsoft, and Broadcom, like we talked about earlier. Now, the investment case is this: 2025 has brought a change to the stock market. Part of that is due to the new administration, but underperformance in the Mag 7 and in technology is more related to slowing earnings growth and high valuations. Now, in conclusion, besides the fact that the market seems to be turning and rotating to safer names like SCHD, like DGRO, or even other dividend names across the markets, it seems that a lot of long-term investors out there, potentially even some of you guys watching my channel, are definitely seeking out some names that are going to bring your portfolio a little bit less volatility, and some quality dividend growth. Now the cool thing about DGRO is that even though you're getting exposure to dividends and dividend growth, you are actually getting a decent amount of exposure to names like Apple, Microsoft, and even Broadcom, which are going to give an ETF like this one a little bit more growth potential, and that's if of course the market turns bullish. Now when the max time frame, DGRO is still trading pretty close to all-time highs, the year range being 55.09 and 65.08. So by no means is DGRO offering a screaming buying opportunity, but honestly, depending on what happens in the market next, we could see a situation where more and more money turns to dividend growth ETFs like this one. So now that we talked about the iShares Core Dividend Growth ETF, DGRO, and I share with you guys why a lot of investors are turning to consistent dividend growth ETFs like this one, especially during the current market situations that we're in, I lastly most importantly want to hear from you guys down below. In the craziness of the market that we've seen so far in 2025, what are some ETFs that you're turning to and adding into your portfolio? Let me know in the comments down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.